Today we're looking at a report on Navitas Semiconductor titled 10x Potential, which digs into their pivot from consumer electronics to high-power AI data centers. Let's get right into the feedback.
Yeah, this piece gets off to a fantastic start. The hook is so timely, this idea that the real bottleneck for AI is just raw energy.
That a single AI query uses 10 times the energy of a Google search? That really lands.
It does. And it sets up Navitas, this company known for phone chargers, as this key player for what's next in computing.
The Navitas 2.0 pivot, right? Where they ditch the low-margin stuff to focus on these gallium nitrate, or GaN, and silicon carbide chips for NVIDIA's next-gen GPUs. It's a very strong, very high-conviction setup.
It absolutely is. So let's start there with the structure. The report builds this fantastic hook, but I think it risks losing the reader by how it separates the immediate financial pain from that huge growth story.
So it's about managing the reader's journey. You have to get them to buy into this amazing future, but you can't hide the ball on what's happening right now.
Exactly. The weakness here is that the structure is it's jarring. You've got the bull case talking about exponential growth, the AI data center market growing, 5 or 6 times by 2030, a $1.25 billion pipeline. It's all incredible stuff.
Okay, yeah.
But then, boom, the reality check section comes in and reveals that Q4 2025 revenue guidance was actually lowered to around $7 million.
Right, because they're dumping the old consumer business.
And that quick shift from, 10x potential to revenue is going down, it can really shake an investor's confidence.
But hold on, if we put that low $7 million number right up front, aren't we just killing the excitement from the get-go? I mean, you need to hook them with the big vision first before you get into the messy details, don't you?
That's a great point, and it really gets to the heart of the suggestion here. The idea isn't to just drop it in as bad news. It's to integrate that timeline, what the report calls the waiting game, into the story of the pivot itself.
So you frame the low revenue as part of the plan.
Exactly. You frame it as a calculated, necessary cost of making this huge change. Not a surprise, but a signal of commitment.
Okay, so you're repositioning a negative data point as proof that management is serious.
Precisely. You manage expectations. So, for example, when you first introduced this Navitas 2.0 pivot, that move from, say, Xiaomi phone chargers to these massive 800-volt loads for AI servers, you state right then and there that this is a multi-year ramp. It's going to hurt in the short term.
You could use a phrase like surgical removal.
Yes, I love that. You explain that the current revenue reflects the surgical removal of that legacy business. You explain why the guidance was lowered.
So maybe something like, and to capture this massive $1.25 billion pipeline, management is undertaking a full strategic transition, which is why the Q4 2025 numbers reflect only the beginnings of the AI ramp, not the old business they've intentionally discarded.
That's perfect, because now the low number isn't a red flag, it's a sign of discipline. It smooths that transition right into the bull case, and suddenly that huge 2027 potential feels much more credible because you've already explained the cost of getting there.
That's a really powerful reframing. Okay, but speaking of costs, what about the elephant in the room, the cash burn?
Yeah? Does the report do enough to address that head on? That's the next big point.
The report makes a great case for the tech itself, The chips are 50% smaller, they run 30% cooler. In a data center, that is a massive, massive advantage.
It's huge, but that advantage means nothing if the company goes under before they can actually sell them at scale.
I agree. So to really land a high-risk, high-reward thesis, you have to tackle that head-on. The weakness right now is that the bull case focuses only on the tech. The existential risk, that negative $96 million operating income, is sort of tucked away in the reality check section.
It's isolated, and that makes the whole bull case feel a little flimsy, like it's ignoring the most important question.
Which is?
Can they survive long enough to win?
Exactly. So the suggestion is to use the sheer size of that $1.25 billion pipeline as the direct counterargument to the cash burn.
So you acknowledge the loss, but you immediately pivot to say, this is what that money is buying. Yes, and you get specific. The report mentions that Global Foundries partnership in Vermont, that's a made in America supply chain. You can't sell into critical national AI infrastructure without something like that. So that $96 million loss isn't just a loss.
It's a strategic investment, it's R&D, it's supply chain security, it's the cost of entry to this new market.
Right. The reader needs to see it as an investment against verified future demand, not just a company that can't control its spending.
You have to ground the future optimism in present-day strategic necessity.
So as a concrete example, when you talk about that pipeline, you should add a sentence that frames the choice for the reader. Something like, the key question then is whether this massive, future-secured pipeline justifies the current negative operating income of $96 million.
And you'd continue, which is the investment required to finalize a domestic supply chain for this critical AI infrastructure.
Yes. Because that question basically answers itself. Of course it's justified. You're shifting the narrative from they're losing money to they're investing to win a generational market. That huge pipeline becomes the proof.
And that ties everything together. The investment is necessary to build the heart that powers the NVIDIA brain. By framing the loss that way, the bull case becomes so much more resilient.
Right. It inoculates the entire argument against the main financial criticism.
Okay, that feels comprehensive. So let's move to the end. The report clearly identifies its audience, tech investors, growth stock traders, and it has a fantastic catalyst. But I feel like the final actionable part for the traders could be a little sharper.
I agree completely. It identifies the short squeeze potential, which is perfect for that audience. What is it, something like 20% of the float is short?
About that, yeah. So any good news could just send this thing vertical. It's a high-energy situation, perfect for a trader.
It is. But the weakness here is that this incredible catalyst is presented more as a theoretical idea in the bull case. It isn't really woven into the final trading strategy.
Right. The actionable takeaway just says, watch the $8.30 level. But it doesn't explain why that specific level is the flashpoint for a short squeeze.
It's like leaving money on the table. For a growth trader, you need to connect the dots. What is the specific trigger that turns this long-term story into a trade they can put on now?
Yeah, that's a huge missed opportunity.
Contract and the market mechanics of the short squeeze. You need to combine them into one single piece of advice.
And that integration is key. But let's just unpack that for a second. Why 830? Is it just a technical chart point, or is there more to it?
It's both. And that's what makes it so powerful. From a technical standpoint, 830 is probably a key resistance level or a moving average. So for traders, crossing that on high volume is a breakout signal. Pure mechanics.
Okay.
But then you layer on the fundamental catalyst. Imagine news drops about a huge contract for NVIDIA's Rubin or Blackwell platforms. Suddenly, the entire thesis for shorting the stock that they can't execute this pivot just evaporates.
I see. So the price point is the win, and the contract news is the why. And for the shorts, it's the signal to run for the exits.
Instantly. So for the concrete example, you rewrite that takeaway completely. Instead of being passive, it needs to be specific and commanding.
Something like, growth stock traders should watch the 830 level closely, as this is the technical point where any confirmation on the size of the NVIDIA GPU platform contracts could trigger a massive short squeeze.
Potentially transforming this multi-year story into an immediate high-volume trade opportunity.
That's it. It connects everything. The macro theses, the AI pivot, all the way down to a micro-execution plan for the target reader.
Exactly. It makes the entire report not just insightful, but truly actionable.
So, to wrap up, we've hit on 3 key ways to strengthen this report. First, tweaking the structure to frame that low 2025 revenue, not as a negative, but as a strategic cost of the pivot.
Second, bolstering that bull case by using the $1.25 billion pipeline to directly justify the cash burn, framing it as a necessary investment in their domestic supply chain.
And finally, sharpening that takeaway for traders, linking the 830 price level directly to the NVIDIA contract catalyst and the mechanics of a short squeeze.
Yeah, this is really promising work. With these changes, it moves from a good analysis to I think, a really compelling high-conviction thesis.
It's a high-risk, high-reward story for sure, and we look forward to seeing the refined material. Please feel free to send your updated work